Great to see you, especially since you've been fairly quiet on social media. No post since late June when you observed that stocks have been priced for perfection, but things remain far from perfect. And since then, we've seen the S&P 500 gain about 5.5%. Credit, both high yield and investment grade have done better, but still modest compared to the S&P. The 10-year yield kind of stuck in a range. How do things look to you now?
Well, Scarlett, when you look at the market, you consider that there are 5 stocks that represent almost 30% of the total valuation. And we did an analysis that showed the relative pricings in terms of earnings yield versus the yield on their corporate bonds. And so you defined that those prices of those stocks are largely being driven around by changes in bond yields. Now, the same thing's true across the board, but of course, those 5 stocks have driven a lot of the appreciation, while value in other sectors have lagged behind. So, it's clearly a function of Federal Reserve policy. And for the near term, I don't think that there's any end in sight in terms of the Fed wishing to drive rates lower for corporate debt. So, we should probably expect that stocks will continue to go higher. But, I am on record as saying that I thought this was a bubble.
Right.
It looks like the bubble that we lived through in the late 90s. And if we recall that in 1998, in the era of irrational exuberance, according to then Chairman Alan Greenspan, and the rally went on for 2 more years. So, the nature of bubbles are that they go long, and they're hard to end up. They're hard to predict how they end, but ultimately, there's probably money to be made in the stock market. But I think risk-adjusted returns, you're better off in high yield and corporate bonds.
Now, you just wrapped up a meeting with the New York Federal Reserve, whom you would advise as a member of the Advisory Committee on Financial Markets. If we can continue seeing stocks elevate for the next 2 years potentially, how comfortable is the central bank with the optimism reflected in the stock market versus what's happening in the real economy?
Well, the Fed is typically very tight-lipped in these conversations. I think that they want to understand it. They're not, I don't think they're sure whether to think of it as a bubble or not a bubble. But one of the comments that was made at the meeting I thought was very interesting is, how will we know if this is a bubble? And the answer is after the stock market crashes. So that's not to say that it implies that the stock market will crash. But if equity valuations remain high or go higher, and then we get an abrupt setback, then that, in their mind, would probably be the definition of a bubble.
All right. Well, in terms of catalysts for that setback, we have something coming up at the end of this month. Patrick Harker talking about a fiscal cliff. Of course, he's a Philly Fed president, and he made the comments to our Mike McKee. You talk to people in Washington. What's the likelihood that this will get resolved in time to prevent that kind of catalyst for a setback that could potentially lead to a crash?
Well, Washington is a hard animal to predict these days. I do know that other than a payroll tax holiday, there really isn't much on the table coming out of the administration. Congress will be back for 2 weeks. I think there's a great risk that there will not be a deal. Unless perhaps we could extend unemployment benefits by a couple of more months. But candidly, a lot of Congress or a lot of senators don't, Republican senators don't think that's necessary. So the risk is high, and are in a seasonally weak time for risk assets. So, I think that the possibility of a severe setback between here and October is probably meaningful.
Okay. Now, one thing that you've been worried about, and you've talked a lot about, even when times are good, is the over-leveraged corporate sector. We're not in a typical recession right now. It's artificially induced, and there's a lot of stimulus here that's pushing back delinquencies. When things do start worsening, what do you think the trajectory will look like? Will it be suddenly and then all at once?
Well, Scarlett, I think it's hard to predict. I think we're going to go through a continuing slow erosion. One of the most troubling aspects over the last 6 months is that in order to stabilize the bond market and then subsequently also to lift asset prices like stocks. We've issued over $1.5 trillion worth of corporate debt. And if you had talked to me in December, I would have told you that we were already in a corporate debt bubble. That was, to me, and I think it is very clear by every metric we have, whether it's actual total debt, debt to GDP, debt to free cash flow. Corporate America has never been this levered. And that was true in December. And $1.5 trillion later, which is more than all the bonds issued in the prior year, we're making, I think, a lot of companies even more vulnerable by lending them money when they ought to be trying to pay down their debts.
Yeah. So how do we get out of this cycle? Because typically when insolvency risk is rising, companies should be trying to deleverage, but we just keep getting more debt, as you mentioned. Where do you break the cycle? How do you get companies to start deleveraging?
Well, I think it will ultimately take some sort of severe setback, a surge in defaults. I mean, that is one way to get debt down, is just to default. And, I'd like to remind people, Scarlet, that the strongest economic expansion on record was between 1933 and 1936. But yet we never recovered back to the levels of 1929. And then ultimately there was a second setback that is what resulted in what we call the Great Depression. So, this artificial stimulus being created by the government, by monetary policy, in the near term, is lifting asset prices. But when you look at Main Street, you look at small businesses, these are where, the majority of American jobs reside. The real economy is not improving at a pace that would support, a continuation or cash flow growth, which could support these companies.
Yeah.
So whether that's tomorrow, that the chickens come home to roost, or whether it's 3 years from now, the day of reckoning will come. But for the moment, my bet is that monetary policy will remain loose enough to continue to drive risk assets higher. And it's probably, for people who are looking to maximize returns, probably the best thing to remain long at this point.
So when it comes to the real economy and preparing for that wave of defaults, we've heard from banks this week who have set aside a combined $28 billion from Citigroup, JP Morgan, and Wells Fargo. I want to get your read on these provisions. Are these carefully considered amounts, or are they stabs in the dark as to what the potential damage could be?
I think they're stabs in the dark. I mean, it's really interesting. At the end of the first quarter, when we had pretty good visibility at the end of March into how severe the downturn was, the banks didn't take very high reserves at all. Now they're taking reserves, a lot of reserves, and that's telling me that they're actually behind the curve and that they're in a game of catch-up. I don't think the reserving that occurred in the second quarter is adequate in terms of what ultimately will be needed. So I think we're going to probably continue to see lots of loan loss reserve provisions going forward for the rest of the year.
Yeah, we may just surpass the numbers seen in the great financial crisis. Now, on the flip side of that, of course, you have the trading operations, which have done very well, notably Goldman Sachs today. One analyst called Goldman's earnings too good, almost indecent, and could create a political backlash. What do you think?
Look, I think in this environment, that's a very, very real risk. The banks have targets on their backs from the financial crisis. They are constantly being identified as the winners every time we have a bailout. So, easy monetary policy, the bond purchase program, which has just stimulated a huge amount of demand to issue bonds and to buy bonds, is resulting in, extraordinary trading profits. And the large profits in these financial institutions are, a target, especially by certain members of Congress, some of the more liberal members. So I think the reality is that there is going to be a backlash for the banks, and especially if there's a Democratic administration that comes to power.
And Scott, one final question. I didn't get a chance to congratulate you on Guggenheim's role in leading the funding for LeBron James's media company, SpringHill. The story that Jason Kelly wrote for Bloomberg really paints a picture of a lot of dramatic last-minute negotiations because the deal was closed the day before the NBA had to suspend its season. Obviously, the world has changed a lot since mid-March. What do you think about the financials of the deal now and the prospects for it?
I think today, Scarlet, they're better than ever. Now, obviously, production is slowed down dramatically because of the quarantines. But in terms of the backlog of business, it's growing rapidly. The events of the prior 6 weeks or so in the area of social justice are making people more sensitive and more aware. And, it's interesting that transaction, I was working on that transaction a year ago. Mm-hmm. And Guggenheim had the opportunity to be the lead investor. And then we worked with Main Street advisors to bring in some other investors for strategic reasons. But I think that our investors today are better situated with the investment they've made with LeBron and Maverick than they were the day we closed.
And just one final quick question. I lied earlier about letting you go. Very quickly, do you see the prospect of a contested election in November? And if so, what would that mean for markets and for the economy?
It's interesting. I think the risks of a contested election are high. I think that how that plays out may have impact, negative impacts on the market. But, history shows that those experiences tend to be very transitory. So I wouldn't necessarily be factoring that into my risk assessment for a long-term investor.